Wow, hello there, egghead wannabes. Have you been thinking about investing in index funds? Do you wish to be one of those index fund millionaires who got their first $1 million from properly investing in the right index funds? Do you want financial independence and be able to retire early? Well, you're in luck because Egghead Finance is here to teach you all about index funds and how it could potentially boost your finances to millions. Alright, the first thing you need to know is the definition of an index fund. It's a portfolio that checks and tracks the performance of different stocks, bonds, and securities. It's a type of mutual fund, but it's important to remember that not all mutual funds are index funds, and they don't all necessarily work the same way. Index funds try to match the index or follow the trend of the market or particular market. Mutual funds, on the other hand, don't match. They want to outperform. They want to beat the market. Now that we have that out of the way, we can discuss the history of index funds and how learning it is crucial in your future investment decisions. It all began back in 1970 by the founder of Vanguard, Jack Bogle. Before then, you could only invest in a group of stocks with mutual funds, which were oftentimes unable to beat the market. Jack Bogle thought, instead of beating the market, why don't we just create something that would mimic the flows of the market? He had the bright idea to start index funds, and people weren't keen on accepting this idea. It created so much scandal and controversy, since this would allow bypassing mutual fund managers, which are a big part of the investing market. Even today, some people are still reluctant to accept the idea of index funds. Haters gonna hate, right? I mean, how could someone prefer to pay a large sum of expense to let someone manage your mutual fund when index funds are financially doing better? So when Bogle started index funds, it changed a lot in the stock market landscape. It allowed people to get rid of fund managers, and it also cut down the costs of investing. Reduce costs and better performance define these index funds because they're tracking the market and not actively trying to outperform it. It also made investing in the stock market more beginner-friendly. There are a lot of mutual funds in the market, and there are also a lot of mutual fund managers out there. It makes someone who isn't familiar intimidated and confused and paralyzed with all these choices. It's hard to pick which mutual fund is performing well. Then, you have to seek out a mutual fund manager who has been managing their finances and investments exceptionally well. Whereas index funds would just match the market, so you just have to find the right index fund for you. End of discussion. It's that simple. And so, an easy investment strategy is to invest in index funds and steer clear of mutual funds and mutual fund managers who are working to beat the market. It's easier to just try to mimic the stock market. Now, we dive deeper into the philosophy of investing in these index funds. Compared to mutual fund investing, index funds are more long-term investments. Since investing in these mutual funds require to be more speculative, you're going to have to speculate that the mutual fund manager will have the right picks for you during the season. But for index funds, you're going to base your decisions on the history of their performance, on the history of the stock market, its trends, its flows, and all the fluctuations that have happened in its run. However, even though investing in index funds is stable in the long term and it's almost automatic, so there's no need to be anal about checking it every time there's a change in the market, there's still a need to understand them, research about their performance, and know which type of index fund to invest in before actually putting in your hard-earned money. If you want to be an index fund millionaire, you should opt to focus on index funds that track the totality of the whole stock market and another that tracks the S&P 500. The S&P 500, for those that are not yet familiar, tracks only the top 500 companies on the stock market, while investing in the total stock market will get you all the small ones and all the big ones too. Why invest in both? Because both indices work quite similarly. At work through your 401ks, the S&P 500 would be ideal. And outside of your 401k work account, it's good to invest in the total stock market. Before we go into the particular index funds with great track records, don't forget to click the like and subscribe button if you've enjoyed the video so far. And why don't you comment down below if you've invested in index funds and which index funds are in your portfolio. There are different index funds in the market out there, but here are our 3 picks to show you. There's VFIAX, or the Vanguard 500 Index Fund Admiral Shares, with a year-to-date of 23.14% and an expense ratio of 0.04%. Next is the Schwab S&P 500 Index Fund, or SWPPX, with a year-to-date of 23.13%, along with their expense ratio of 0.02%. And third is FXAIX, or the Fidelity 500 Index Fund, having a year-to-date of 23.17% and an expense ratio of 0.01%. As you can see, these index funds have very similar year-to-date and expense ratios. So, it's not just a matter of looking into their performance, but also to look at the brokerage firm that creates these index funds. An example we can look at is this index fund Rider S&P 500 Class C, RYSYX, under Guggenheim Investments. It has a year-to-date return of 20.5%, which is performing well. But if we take a closer look at the expense ratio, it's 2.4%, and that's 60 times higher than VFIAX, which had the highest expense ratio in our 3 picks. It's an index fund that tracks the S&P 500, but it's taking more money from the investors and giving them less in return because of their expense ratio, which is influenced by the brokerage firm. So, when selecting an index fund to invest in, it's crucial to look into the company that you're going to invest your money in. Some brokerage companies have higher service fees, while there are those that charge you for less. And when investing in index funds, less fees is always better, since all these index funds are just tracking the same indices, so it shouldn't be any different for all of them. If a firm is charging you a 2% expense ratio for their service to track the S&P 500, then, my egghead friend, you are being overcharged, maybe even robbed. So, to start off your $1 million journey with index funds, it's important to find and understand the right index fund for you and your finances, and to know the brokerage firm that handles your investments. Always do your research when investing. Remember, this is not an actual professional finance advice. An Egghead Finance is just here to give you the right information when you need it. And that's the end of the video. We hope we gave you a clear description of index funds and how you can get your first $1 million. And if you found this video useful, please subscribe, click the like button, and hit that notification bell to get alerted about our upcoming videos so you can always stay informed. We are looking forward to seeing you with your first $1 million, aspiring eggheads.